Welcome, everybody. As mentioned previously, this is a traditional annual student housing report session around the release of the information and data to the last and next year. We have over 1,100 registered participants, global audience from 5 continents, over 550 investors and about 50 bankers. We have 4 distinguished guest speakers that will be accompanying us during the panel session after the presentation. The top brands represents over 50,000 pets, and we are happy that they will be sharing a bit of experience and knowledge with us. Report itself will be available after the session to all registered participants. We will be sending it later this week over the email. Report will be also on demand for those who did not register at bonar.com in a section Insights. For media, if they want to cover more than just the report and session, we will be available for more details after the session. The report itself this year has 24 pages. We covered all the topics done in the previous 3 years. And we included some new topics, including amenities, room sizes, rent time series, and occupancies and others. Geographically, we included also Canada, Australia, LATAM, and they are also proportionally covered in this session, as we have about 50 delegates from each of these continents at this session. After my initial intro now, in about 1 minute, I will give the word to my colleague Martin, who will make initial presentation, which will last about 20 to 25 minutes, and give you a sneak peek to the report and guide you through the overall details of the year. In a nutshell, 2022 was stronger in many factors, occupancies, rents, transactions. However, there was a slowdown in Q4 in transactions and sort of a cost related to the increased inflation and interest rates. However, student housing has not been as affected as the other asset classes, and be it possibility to improve and increase rents quite rapidly, unlike in the other asset classes, as well as the higher demand that this asset class experiences in the economically difficult times. The asset class has noticed quite a lot of interest, both from the capital and the tenants. Therefore, is better position for the times to come. But with this, I will probably give word to Martin, and he will provide a bit more details, and then we will move to a panel with our 4 distinguished guests, where we will elaborate a bit more on a report presentation, the year that passed and the year that is about to come. Martin?
Thank you, Samuel. Thanks for the introduction. And firstly, warmly welcome to everyone joining our traditional housing report 2022 edition. I'm just going to quickly share my screen so you should already see the presentation. As Samuel mentioned, we basically, as per previous year and per previous reports, which can be all downloaded at the Insight section of the Bonar page, we kept a consistency through the KPIs that we usually measure, with some additions. So we added some room sizes, we added some additional KPIs to enlarge the report itself and to enlarge the assessment of the student housing markets in different jurisdictions. So as for today's topic, we'll touch base the basic demand, supply, and provision rate enrollments, and as well the rent dynamics in selected jurisdictions, which will be linked to amenities and room sizes, followed with the future forecast for the pipeline, so how many assets are coming into the market in terms of planning and development, and as well the PBSA brands in terms of the portfolios, their sizes, deals, and yields. Before getting into the content, I'm pretty sure that many of you are already aware of Bonard, but for the ones that haven't come across our brand yet, just a brief introduction. Bonard is the intelligence and advisory firm focusing on the rent residential asset classes, which includes the student housing, co-living, service apartments, BTR, and senior living asset classes. Over the 15 years of the company that is already operational, we managed to deliver more than 600 projects, which was done by our intern specialists, which are now basically the number of 91, which are spread across core offices in different continents, be it Europe or China, and are using more than 1,800 unique data sources. Based on those sources, our team over the years managed to establish interactive platform and a big granular database for 253 markets and submarkets, which consists of the asset level details and information for more than 13,000 operational PBSAs in those markets. Now getting into the content, I would firstly, as per standard, like to start with demand. For 2022, the recovery of stable demand indicators were crucial. During the pandemic, and many mainstream asset classes faced challenges, which led to some downturns in the demand and later on in occupancies. However, for the rent residential, and which includes also the student housing, the demand either remained stable or it continued to increase. Especially the PBSA asset class maintains its very strong position here, which ended up in a higher occupancies, and given the low provision rate in selected markets, it creates a very great environment for the potential investments. Here on the first dashboard, you can see the two comparisons in the demand change over the years. On the left side, you can see the total number of the students, where we can see the Greater London is leading the ranking, followed by Greater Paris and Turin. However, we can also see the presence of some Australian cities in top 10 jurisdictions. In terms of international students, the ranking is a little bit different, and it's come mainly from the European jurisdictions. So on top of the list, we can see the Copenhagen, Glasgow, and Brussels leading the way. However, we notice also the higher enrollment of international students in Toronto in Canada, which is basically considered as the main hub of the students in this region and continent. And how does it reflect in a provision rate? So the current operational stock. Firstly, you can see the total student population and as well the total international student population. On the left side, we can see that the Brazil leads the way quite significantly, followed by UK and Greater Paris. In terms of international students, it's again a little bit different. London is again leading the way and followed by the two big cities in Australia. If we take a look now at the provision rates, so the graph on the right side, it basically measures and benchmarks the missing stock on the market versus the provision rate. Our team of experts established a 25% benchmark when it comes to provision rates, which means that when the market is reaching 25% best students ratio, the market is becoming more or less more saturated and more challenging in terms of the more competitive market. Given the graph, we can see that Toronto in the tier 1 cities is having 11% provision rate, but still the biggest amount of the missing stock that could be deployed in the city. On the other hand, if we take a look at the most and the biggest provision rate, which is in a tier 2 city, Edinburgh, we can see that considering 25% benchmark, there is a lower number of the beds that are basically considered to be missing in this market. In general, we can see the trend that tier 1 cities are missing more beds comparing to the smaller cities due to higher demand enrollments and due to higher demand structure coming to the market. And altogether, the low provision rates, the higher demand enrollment, together with such a low kind of operational stock in the markets, reflected also in occupancies. In post-pandemic times, the PBSA asset classes recorded another year of very high occupancy rates across all the countries. While some countries faced lower figures in 2021, as you can see, Spain was at a level of 87%. 2022 brought them back to the market benchmark, and Spanish cities are now recording 97% of occupancies in 2022. Overall, the occupancy rate in screened jurisdictions were at the level of 98%, and we've seen the lowest 95% in Austria and Switzerland. And how this all together with the lower provision and higher demand affected the rents? Here we have two slides. Firstly, it's going to be rents and amenities. And the most important feature of the PBSA sectors in general remains its ability to make flexible rent level adjustments. Operators commonly adjust the rent levels several times per year, and following the asset performance, they wanted to maintain the NOI margins. Inflation has affected, of course, all stages of PBSA investment cycle. Prices of materials continue to rise in 2022, together with rising utility costs. That also impacted the development and operation expenditure indeed. However, part of the rise in operation costs was reflected also in increased rents to reduce the impact of these costs on the balance sheets. As you can see on the graphs, on the average, rent levels in tier 1 cities have increased by 4.9%, bringing the average monthly rent of a single studio to 946 euros. Geographically, the highest increases we've seen was in Canada and Australia, 8 and 7.9% respectively. If we take a closer look at the European countries, though, and we break down a little bit more, we saw also very much higher increases in CEE region in terms of the rents, where the rents rose by more than 20%, which is mainly due to the lower provision rate and in general the less competitive market. And given the fact that the PBSA asset class is characterized by the sense of community, the amenities on offer represent a significant part of the residence. And with increasing rent, we can tell that there might be even higher pressure on the quality of the living in the PBSA amenities. And that's why we took a look in the current amenities on offer, and we distinguish for the private PBSAs that opened in the last 3 years and the stock that is older than 3 years. The most significant trend in the modern layouts is the presence of amenities such as gym, games room, study room, and similar. Modern stock opened in the last 3 years has also tended to provide bike storage and outdoor areas. However, on the other hand, due to recent technological developments, communal areas such as PC room or libraries are gradually being removed. And in general, in terms of the room type, we've seen that the studio concept has grown in the popularity, which is also the next slide focusing on. Here you can see the comparison of the room sizes in different jurisdictions in terms of a private single studio, and as well the average rent per square meter. So on the left side, you can see that Denmark is basically providing the biggest room sizes, while Australia is providing the biggest rent per square meter. The average size of the most represented studio in 2022 was at a level of 19.9 square meter, so almost 20 square meter. And the average price per square meter in tier 1 cities was at a level of 42 euros per square meter, while in tier 2 and tier 3 cities was at a level of 31 to 32 per square meter. And looking more closely at the graph here in the middle, you can see that Denmark, as mentioned, has the biggest room sizes, but on the other hand, the average rent per square meter are lower compared to the rest of the world. While in Australia, where the room sizes are at a level of 21 square meter, the average rent they can squeeze out is 62 euros per square meter. If we take a look also at the market that are coming to the development stage in the recent years, like Spain, Portugal, or Poland, we see the trend is coming more towards the average. So when we take a look at Spain, we can see the average room size of the studios is already at the level of 20 square meters. The same for the Portugal and similar for Poland. So we can see that given the bigger pressure of institutional money, we see that the project is becoming more institutional as well and is meeting more of the criteria of 19 to 20 square meter studio. And how does this pipeline is active across the different jurisdictions? So here we have comparisons of what was delivered in 2022 and what is and was still in a pipeline. Firstly, I'm going to focus on the graph on the left side. Within the top 10 cities, in terms of the stock increase, it indeed included traditional destinations such as London, Paris, but moreover, we see that the bigger pipeline has been in Porto, Barcelona, and Sevilla, which reflected the increased development activities in Iberia, which started in 2019 and 2020. In total, the PBSA market grew in a volume of more than 61,000 beds in 2022 in 253 European cities and jurisdictions that we measured. And in terms of the assets that are still in pipeline, which is now on the right side, you can see the data as of December 2022 that based on 961 assets in the pipeline, more than 35% were already under construction. If we take a closer look at the cities, the Greater Paris is leading, followed by Greater London in the total figures, which is also in terms of under construction. So under construction, Greater Paris and Greater London are at the top two places in the ranking, but it's followed with Berlin and Amsterdam. With this increasing exposure of the stakeholders and the larger pipeline and activities across the market, the number of existing operating private portfolios across the continental Europe and the UK has rose over the years as well, which leads me to the next dashboard, and this is the portfolios. Our team, due to granular data on the asset level, managed to put together all the portfolios in the student housing in UK and continental Europe with the granular understanding of the ownership structure, territorial footprint, and their sizes. You can see the ranking by the brands on the right side. So Unite remains the top portfolio with more than 75,000, with a presence mainly in the UK and only in the UK, as you can see. In general, if we take a look at the 10,000 plus portfolio, you can see the spread and the distribution of the portfolio mainly in the UK. While if we take a look at the 5,000 to 10,000 portfolios, you can see already more dots across the continental Europe, which is also in line with the market that we observe and see that continental Europe is, of course, more in development stage, and while UK is the most major market in Europe. Social Hub is leading in the continental Europe, soon to reach the 10,000 beds, followed by Resta in Spain. We also seen, and we recorded several major deals within the portfolios as well. And basically, that was the portfolios that reached the 5-year investment cycle, and they followed the certain portfolio exit strategy. This more complex slide, and you can see more numbers, but I'm going to slowly guide you through it, starting with the total PBSA transactions. The post-pandemic transaction optimism observed at the end of 2021 continued into the following year, and the accumulated capital and exit strategies of several key players resulted in the most of the 100 million plus transactions recorded in 2022. Whereas 2021 saw smaller transactions, especially in continental Europe, in 2022 we saw some large volume deals already in this region as well. Of course, there's been many uncertain and economical factors by the end of the year. And I can also notice, and due to our data, we've seen that major of the transactions happen in Q2 in UK, while in the continental Europe, it was mainly in Q2, Q3, slowing down in the last quarter of the last year. Some maybe deals to be mentioned was in continental Europe, be it Exeter acquisition of Basecamp and strengthening their position in continental Europe. GIC and APG acquired the substantial stake of the social hub, so the previous student hotel from Airmont. In Iberia, we've seen that PGGM took over the Resa from the previous partnership of AXA, CBREIM, and Greystar. In terms of the UK, of course, the deal which significantly raised the total performance was the acquisition of Stunerus by GIC and Greystar. But there are also other, like Tristan Capital Partners and Briggs Group, that made their first significant 100 million plus acquisition of the year, followed by Lone Star's acquisition of 11 assets from Unite for more than 300 million pounds. So we've seen some movements. However, it is expected, and expected trend for the yields themselves is temporary. The yield will be increasing, which is also predicted to continue in 2023 and can be already seen in some of the countries. However, if we benchmark the yields to most of the traditional asset classes in most of the cities and tiers, we see that the BBSA dominated with better returns comparing to the others. Heading to the platform, our team has been developing an interactive dashboards and platform, which basically summarize our 15 years work, data collection, insights, and field knowledge for more than 250 cities globally and more than 13,000 assets that are already operational. It includes also the PBSA portfolios, transactions, yields, and pipeline indicators. And it's already used by key stakeholders and dozens of subscribers, which basically helped us to fine-tune and to prove this interactive platform. And it's also available for any who would be interested and starts from 20,000 per annum. Feel free to reach out to us so we can set up a demo access so you could properly test it. You could assess all the functionalities and you can see the added values of such a up-to-date and real-time access. Leading to the last slide, concluding the presentation. Firstly, I hope you found the presentation useful. Once again, it was my pleasure to share the 2022 market developments and trends with you and to guide you through some standard KPIs over the year. As for the follow-up, we would be, of course, happy to arrange a complimentary consultation session with our team of specialists, and we'll be happy to explore in more details, be it the selected country, city, or trends that you would be interested in. So please feel free to reach out to us, and we'll be happy to arrange it. And as well, feel free to visit our webpage at the Insight section to download be it the report or any further materials for you. Many thanks for your attention, and passing the word back to you, Samuel.
Thank you, Martin. Let me also add my overarching comment, and then we will proceed to the panel. It seems like 2022 has been affected, but with the macro, but less than the other asset classes. And in Q4, it was sort of a transition or adaptation quarter that all of us needed to sort of adapt to a new reality. Also, many of the investors and buyers didn't proceed with the transactions as they didn't want to be seen as buying at the peak of the market. But now we are in a situation where the occupancies are higher, the rents are up in most of the geographies twice or three times more than the year before. On the other hand, we have interest rates increased, and they are sort of expected to increase only mildly more in 23. The development costs have been stabilized, which was the challenge of the first half of last year, but less so in the second half. Developer margin was also adjusted, and negotiations with the GCs are now a little bit easier than in the previous half of the year. What has not changed is the cost of land. And that's basically what most of the investors and capital is a bit waiting for the correction in this front. If only, let's say, 10% of the correction of a cost of land or asset would be adjusted, and that would release a lot of potential acquisitions or transactions, as we see from the financial appraisals. In 23, we can see even greater institutional capital demand for this asset class. On the other hand, there are some written expectations either on the private equity or institutional investor side. So seems like the situation is different from GFC in 2008 and 9, when sort of the situation was different, mostly that there was not so much capital available, which is not the case now. It's just that the returns don't meet the criteria yet, and the IRRs probably increased from 15 to 18% expectations in private equity in a 4 to 5 year cycle, while the institutional investors expect probably 50 bips higher yield when buying on a forward deal or JV structure. So it seems like 23 will bring more capital, more opportunities, but we will probably, all of us, sit more on a financial appraisals. We'll calculate more to make sense to the particular cases. And this all we plan to cover, including in the panel, including the topics that were somehow touched in the presentation and will be touched in the report. The panel format will be as interactive as possible with 4 of our distinguished guests. Plus, we will launch a few poll questions so that we can feed the conversation as well as provide some feedback to the overall audience, and we can all have a bit better feel of the market at the moment. So stay tuned during the next 40 to 50 minutes. And as for now, I would like to invite our panelists to turn on the camera and when they speak, also the microphone. And with sort of this, let me welcome Rob from GSA, Jochen from the Social Hub, Josh from Harrison Street, and Mark from Aparto. And gentlemen, if I may kindly ask you to make a short introduction of yourself and the company you represent, and then we will proceed to particular topics. Rob, can I ask you to start?
Yeah. Good morning, everyone. Hello, my name is Rob Waterhouse. I'm the Transactions Director for GSA. Brief background on GSA. We've got a leadership team that's been in the sector for over 30 years. So it's fair to say that we know student accommodation very well. This is all we do on a global basis. We've got $6 billion of assets under management, and that's 110 assets, which are across 70 cities in 7 countries. So that is a very high-level overview of GSA, but it's also worth noting we have a sister company which goes by the name of Yugo. They are our operating partner and operate the vast majority of our portfolio, and they also provide third-party management to other parties. And we also have Kinetic as our sister company, who are a debt provider to again to the living sector, but primarily to the student space at present, focusing on Europe.
Jochen, may I ask you?
Yes, hello, good morning all. My name is Jochem van der Broek. I'm responsible for the debt portfolio within TSH, so both managing the existing debt as well as the acquisition of new debt to fund their developments. We are now called the Social Hub, indeed, as you mentioned before, but we recently changed names in October. Before we were called the Student Hotel, which was a fitting name, but very much focused on the student component and not so much on the other business line that we have in our facilities. We have a true hybrid offering providing both student accommodation as well as hotel, co-working, and F&B, M&E, facilities in our hotels. We have 23 properties, 10,000 rooms secured at the moment, and active in 8 countries. So that's a very short snapshot of what we do.
Thank you, Joachim. Josh?
Good morning, everyone. My name is Josh Miller. I head up the transactions team for the UK and Europe at Harrison Street. And just for a quick overview of Harrison Street, so we're a global investment manager, currently with about $53 billion of assets under management between North America and Europe. We're solely focused on investing in the alternative real estate sectors. And what that means, for our European and UK platform is that we're actively investing in PBSA, of course, build to rent, life sciences, and senior housing. I'd say, PBSA has been the bedrock of our business, frankly, since we were founded back in 2005. And between North America and Europe, we've invested over 215,000 beds since we were founded. About 21,000 of that has been in the UK and Europe.
Thank you. Mark?
Hello, everyone. My name is Mark Sampietro. I'm head of European living projects for student housing for Hines, the real investment fund. Let's put it apart of the brand. We spanned last year during COVID, the brand in the south of Europe. So in total, we have already opened 17 properties between UK, Ireland, Italy, and Spain. And we have already developed also a pipeline for the future in the main cities in Europe. So our main goal is to be one of the main European student accommodation brand in order to operate this asset class of living. So thank you for the invitation.
Thank you. And now perhaps I will commence with the first question and start with lightly, if I can ask all of you. How does your experience from last year relates to the presentation and overview of the market that Martin presented? We will naturally touch upon the particular areas like rents and yields and occupancy, etc. But maybe we can start from the overall feeling of the market. And if we can do the same order, that would be nice.
Thanks, Simon. I think from a headline, it's a very useful presentation, which gives a fair reflection of what we're seeing. Clearly, student accommodation as an asset class is becoming more and more known, primarily across mainland Europe. It's been around and is certainly well documented in the press in the UK. We know that there's a housing shortage on a global basis. And that's starting to now filter its way through into the student space. I think what's very interesting is we talk about low provision rates in mainland Europe, and we talk about the international numbers. But what we have seen is in markets where there are strong PBSA and decent provision rates, the international numbers grow, and that's largely down to the fact that universities can house international students with quality accommodation, and that attracts more internationals into those markets. So I think overall it's a very fair reflection of what we've seen.
Thank you. Joachim, your view?
Yes, thanks, Samuel. Looking back at 22, you can confirm indeed what you have presented before in the report. We see obviously the return of the international students to a large extent, with universities back with physical education. With demand, strong prices have also recovered as a logical consequence, and I think that was also reflected in your report before. The focus is on has been very much and will continue to be, in our view, on experience and lifestyle offering. We get that back from our students. It is going to be key also in the years ahead, as will be community. So I think if we look back, these are is what we have seen in 22, and also what we expect to continue to see in the years ahead.
Thank you. And Josh, if I can also ask you to compare UK, Europe, and US, as you have exposure across the markets, that would be nice.
Sure. Yeah. I mean, I think in looking back at kind of what's, our experience on 2022, I think it's important to kind of bifurcate things into two buckets. Probably the first being the investments and transaction side of the market, with, you know, in the second hand, the operational side of the market. I'd say from a transactional perspective, you know, I'm not saying anything overly insightful that anyone doesn't know already, but obviously that, you know, the second half of the year certainly had its challenges, whether it was Ukraine situation, rising interest rate costs, continuing to rise build cost, and, you know, other challenges. You know, it made launching new transactions obviously much more difficult. And I think, you know, across the institutional investor community, the bar has really been raised in terms of, you know, the threshold that's needed to get deals done. I think that's likely to continue for some period of time, you know, into this year as well. But it's interesting to contrast that with what we see on the, you know, the occupational side, where, you know, across our portfolio, and I'm sure most of the other panelists are seeing this within their portfolios, you know, from an occupancy perspective, from a rent perspective, we're doing very well, right? I mean, I think it's been, you know, one of the best years, frankly, since we've been in business in Europe, and I think we're seeing a lot of the same trends in the US as well. Now, there are some what I would classify short and medium term challenges, probably on the operational side of the business, with things like utility costs. You know, finding personnel, you know, and staff is a challenge as well. So there are some issues that need to be worked through over the short term. But I think on the operational side of the business, you know, it's a very bright story. And I think when you look at the sector more broadly, looking back to, you know, probably the past two black swan events, kind of, you know, the GFC from kind of 2008 to 2010, you look at COVID, the performance of this sector relative to most of the other real estate asset classes actually has been a bright spot. And I think in terms of areas where you'd want to be investing, you know, as global equity at the moment, this is a great defensive sector.
Mm-hmm. Thank you. Mark, what's your perspective?
Yeah, I completely agree with all my colleagues. And I think that the results that we are getting in 2022 and the coming 2023 of increasing occupancy and also increasing in rents in a different way from the past years, I think it's coming mainly, as all of my colleagues said, is the international student that has grown a lot. So we know that they have more budget to pay for the rooms. But it's true that what we are seeing since 2022 and also for this next academic year, that we will need to focus now on the quality product, service and experience, but also keep on, as George said, on ESG. So at the end, we don't need to forget that we are delivering service and experience to those students. And even if it's young population, they are quite used to take a look on the quality and the experience package that you are going to offer. So it's not only a nice room, but it's also what we discussed before in terms of amenities. We see that main topics like cleanliness or security has grown after COVID, that's for sure. Before COVID, it was on the list, but it was not on the top 3. So that's why also in the South European markets, the cleaning is much more common because of that, but it was also included in the rents before. So now it's much more often that people ask to this service included in the rents. So ESG as well, not only from the construction side. So for sure at Hines, it's high quality and we get some LEED certification gold in the buildings, but it's not only in the construction side, also in the product and service and experience that we are offering to our students. So those kind of topics, I think, will be key to support the occupancy, the high level of occupancy and the high rents that we are going to get this year and next year as well. So this is our main focus today.
Thank you. And with this, perhaps I would touch upon the topic of demand and occupancies. And before perhaps I go there, Gorazd, if you can launch the first poll question number 5 on occupancies in autumn 2022. And if I can ask the audience to look at the question and vote if this is relevant to you. So the question is, what level of occupancy did you record in autumn 22, which means either on the Northern Hemisphere, the first semester that started in September, October, or if we are on a Southern Hemisphere, sort of the semester running in autumn 22. And you can vote on these levels of occupancies. While we probably leave this open for 30 to 60 seconds, I will continue our conversation. I was really shocked when I saw 12.3% increase in international students in the UK, which came from HESA, or 8.2% increase in France. These are phenomenal numbers and probably confirm what was said by all the panelists. On the other hand, we see, and we will discuss it later on, slower pace of construction delivery based on the higher cost in previous year. We see sort of HMOs and flat sharing rents being taken by general population because it's less people that can afford to buy, and therefore people opt for rent, so less options for students. And we see more increased demand, especially from 18 years old in some countries domestically, or international students that sort of increase the numbers massively, like in the Netherlands, where the situation is really critical, or Canada, that's students almost live in tents. So with this, perhaps let's close the voting, see the result, and I would probably ask the panelists to comment the results and comment the overall situation, especially where sort of we see the occupancies next year in September 23. So the results of the polls, for those who are on a phone and cannot see the screen, 96 to 100% occupancies are among 56% of the audience, 91 to 95, 24%, and 86 to 90, 13%. The other lower number are marginal, less than 2%. So it's mostly 90% plus, and more than a half, more than 96% plus. So maybe, thank you for everybody for voting and having a sort of a general feeling from the market. And if I can ask the panelists, where do you see sort of the occupancies now and in September 23? What will happen with the market, and will we impact the increase of rents as well, etc.? Maybe we can start with Mark this time.
Yeah, so it's completely agree with the percentage. So we launched already the campaign, the academic campaign for UK and Ireland. So in terms of pickup comparing to last year, we see a huge growth comparing the numbers from that we did in last period. So it seems that the pickup is continuing growing in those markets that we launched already for the next academic year. And at the same time, the rents are increasing in UK and Ireland, an average of 7% comparing to last year. So those are really good results that are coming up until we will be fully booked. I think from related to the occupancy levels, as I said before, it's mainly driven, at least in our side, from international students. At the end, what happens is that study abroad programs, they need buildings with so much number of rooms that if you, for instance, in a part, we have an average of 500 rooms, more or less. So they need this kind of buildings in order to bring all of them in one unique building, because what happens before, if they don't find this kind of facilities, they need to split all the students around the city between student housing, apartments. So it's complicated to manage. The volume that has increased on international students allows to these kind of properties that are big, like us, with an average of 500, to bring much more students in our building. So I think it's relating to occupancy increases comparing with the market they come from.
Josh?
Sure. I'd say at a high level, and just to give some context as well. So, we're active in UK, Ireland, France, Germany, and Spain at the moment in terms of our operational assets. What we're seeing, in the portfolio at the moment is consistent, I think, with the poll results. So for the 2022/23 academic year, we were generally in the high 90% across, our entire portfolio, from an occupancy perspective. And I'd say looking ahead to next year, we're obviously launching the pre-leasing cycle now. We're actually already ahead of where we were for this year as well. So I think, next year is looking to be, at least as good, if not even better, actually, than this year was. I think Mark kind of hit the nail on the head in terms of rent growth. I mean, we're certainly seeing, north of 5% really across all of our markets. And, of course, they're very widely, in some cases, market by market, but generally north of 5% relative to, where we would generally see 2 to 3% in a normal year. So I think that continues to show, the overwhelming demand and also the lack of supply coming online in a lot of these markets as well. And I think, it's interesting, you even look at, there are some market specific nuance as well. You look at places like England and Wales, where, there are all these EPC regulations that are coming into effect over the next couple of years for HMOs. And a lot of the private landlords, just frankly, won't be able to continue to rent those HMOs to students unless there's, some political changes and, and some grandfathering of some of those older units. So I think you actually could see even the supply side of the equation become even more difficult in a market like this, just as one example.
Yeah, very, very interesting point about this HMOs that will probably start disappearing from the supply. Jochem?
Yeah, we can also confirm the percentages at the close to 100% across the portfolio in Europe, even for new assets new hotels that we opened in Spain, southern Europe, where we opened Barcelona, Madrid, and also Toulouse. Just slightly after the start of the semester season, which of course is not great, but even though we see now pick up for the second semester starting in February, for us it's a bit different, I guess, compared to pure PBSA, because we also have hotel offering, as I explained before, so that also allows us a bit to switch with hotel market also being very strong and having had a very, very strong summer. We even chose to reduce the allocation towards semester beds a bit, even though that market demand was very high, but to capture tailwinds of the hotel market. So yeah, we see that across the board. We are launching the 2020 or the September 2023, as in semester 24 sales later this month. Or next month, February, I should say. We're still in January, but we do expect further continuation of this very high demand. And also, and I think that's important to mention, which we have not yet seen to such a great extent, return of international students, yes, but what we will also see is return of US students and also Asian students. So that will bring further demand into the equation and further upward room for increase in prices, although we want to be moderate about that.
Thank you. Rob?
So there's going to be a similar theme here, but largely echoing a lot of what Josh has said. So we've got 40,000 beds, as I mentioned, 7 countries. That's from the US all the way down to Australia, and a large consolidation within Europe. And we're also operating at that high 90% occupancy, and that's even taking into account Australia, which has only more recently or most recently opened its doors. But what we are seeing the benefit of, and I'm sure some people may have seen in the press recently, China actively encouraging students to get back out into country and study abroad. They will not accept qualifications from a home study, so that's obviously very good news for our sector. I'd also highlight that in terms of sales this time last year, we are tracking above that, and that's taking into consideration similar rental growth numbers that Josh alluded to, in terms of sort of mid-single digit, sort of 5% sort of rental growth across the market. And I think the other key thing here is this supply-demand imbalance is only going to widen over time. We've got a combination of factors. We've talked about the number of 18 to 24-year-olds increasing out until 2030, so that's going to increase that demand. We also know that the number of middle-class families are trying to encourage more and more of their children to go to university. UNESCO talks about 260 plus million students at university or higher education by 2030. That's a 25 million increase on where we are today. So coupled with other development challenges, which some of you already referred to, there's certainly going to be, I would have thought, strong occupancy, but that's still going to be targeted at the quality assets. And Mark's point that he touched on earlier, it's going to focus on making sure that it's not just quality location, quality asset, but it's also the operator, how they're managing, are they covering off the ESG components as well. So all of that will prove very well for those that are investors of quality accommodation with strong operators.
Yeah, I can relate to it. that what we are hearing from our partners and clients is that with their sales for September 23, they are ahead. Also, Mark mentioning Josh, Jochen. So it seems to be affecting, and this is even against the fact that the rents increase, like in Australia, increase 8%. And the occupancies are north of 90%. During COVID, the occupancies were 23 to 33%, as Australia was pretty closed for international mobility. So that's also a testimonial to this sector, how it is elastic and flexible and quickly recovers. And it's another good news, and that basically this is showing the overall strength even in these economically difficult times globally. With this, I would probably touch on supply that Rob mentioned. I will start with shorter statistics about completions. So from 2018 to 2021, we had about 45 to 50,000 new beds being delivered to the market globally, excluding United States. So in 2022, so last year, 70,000 beds were delivered, so almost 30% more. In 2023, we have 77,000 beds being delivered if construction goes on time, so 10% more. But in 2024, as we have visibility and can for September 24, because most of the buildings should be in construction now, the completion is half that, so about 122 buildings with 38,000 beds. Of course, this might be without the visibility of the assets that will come to construction in next 3 months. So obviously, we need to take into consideration that some beds might be added. But still, if we compare the statistics from this time of the year, the previous years, it seems to be less completions in 24. So obviously, there is a challenge with construction, with delivery. Things are slowed down, and this will have a tremendous effect on widening the gap in between the demand and supply. As supply is not growing as fast as students, is not growing as fast as previous years, while students are growing faster than previous years. And that's probably a very strong story for next year or two, if not more, with times to come. So maybe if I may ask, how does it relate to your experience? And please feel free to take the stage as you feel fit for the question. Maybe Rob or Josh, if you want to touch, open up to you.
Sure, I can start there. Maybe I think, Samuel, I agree with everything you just said. I mean, I think probably to dovetail with some of the comments from earlier, I think, at the moment, launching developments is, undoubtedly more challenging than it's been over the last couple of years. When you incorporate a lot of the rising build costs that, that we've seen here over the last 12 to 18 months, the increasing financing costs, and in some of these markets, planning, frankly, has gotten much more challenging as well. So even navigating that on the the real estate and construction side of the equation has become more difficult. I think that does continue to present a pretty attractive opportunity in this sector, certainly for the portfolios that I think all the panelists on this call have built. I mean, the supply demand imbalance is just going to continue to be exacerbated probably over the next couple academic years before we have a chance to catch up. So I think we anticipate that continuing. I will say, on the bright side, hopefully we're starting to get to a place where inflation's plateauing. Everyone is being able to take maybe a firmer view on where financing costs are going to look over the next 12 or 24 months, and hopefully we're near the plateau there as well. So we're optimistic that hopefully that will start to unlock the market more so than than has been available in the last half year or so. So I think hopefully things will start to unlock at some point over the course of this year.
Thank you. Anybody else wants to react to this challenging situation?
Well, maybe I think I agree, obviously, with what Josh said. I think what is going to be interesting to see in terms of where the market is moving in the coming period with this uncertainty because for new developments to be launched, there also needs to be market activity, and this is with although probably inflation leveling off and interest rates consequently also coming down in the foreseeable future, there is still quite a bit of market uncertainty. So the question is, what is the moment? And also in terms of at least looking at the properties that we are keen to develop on good locations in A or B cities. They're obviously not always PBSA locations as they come up for sale. So sellers will also need to be able to realize to swallow potentially losses in value, and have to be prepared to do it. And we think that may still take a bit of time. So that doesn't bode very well for the near future in terms of the pace with which new developments can come into play. So it's difficult to see how that will pan out. But I think this is going to be the game for the coming months. So
I think that's right. And just to add to both Joachim and Josh, is the developments are going to become harder and harder at this moment in time, not only because costs are going up, but it's also the availability of debt. We know that the banks are only going to lend to people with that strong track record, and also with an operator with equally a strong track record. We're seeing that now, and I'm sure there'll be many parties out there that will either need to refinance or have tried to refinance over the last 6 to 12 months and found that pretty challenging. So I fully expect that to play out into the development space as well.
Great. Maybe I move to rents now, and I will ask my colleague to launch next question about the rents, question number 4. Where do you expect rents to be in September 23 compared to Q4 22? So this academic year versus next academic year. For those who can only hear, where do you expect rents to be in September 23 compared to Q4 22 levels? Option number 1, increase by more than 4%, then increase by up to 4%, same as now, decrease by up to 3%, and decrease by more than 3%. While we keep this question open, I would probably start very sensitive topic. Basically, on one side, this asset class is probably less exposed to inflation and changes of this kind because it can change the rents more frequently than office or retail. And on the other hand, it's not immune to the macro changes and increase of costs, operational costs that represents about 20% of the total costs. We see that people are trying to offset the increased cost of operation to increase rents, and some of them succeed to do it fully. Some of them even greater increase in the rents and improve NOI. Certainly this is somehow more safer environment for investors. But I would like you to comment. You have a lot of operational experience. You have a lot of bets, different geographies, different cost increases per geography, as well as different inflation or rent increases that are possible thanks to the competitiveness of the market. So maybe if you can somehow touch up on this relation or correlation in between increased cost and rents, and how successful we are to offset the cost with the increased rents. Mark, can we start with you? You have 17 assets, so.
Sure. Yeah, so as you said perfectly, so the increase of costs mainly in the OPEX and the P&Ls of the properties is coming, as you know, from utilities perspective. So energy costs has been huge huge amount comparing to other years. And this, in a part, will be covered by the increase of the rent, not all, because we are expecting also the next months how will be performed. We hope that it will be better situation than in the past. But for sure, at the end, as I said before, we need to improve also the quality and the experience of the service that we want to deliver. It's not only, and also we need to imagine that these people that is paying more rents for next years, maybe they were in our buildings before last year. So if you increase rents, they increase also the expectations of what you are going to offer. That's why it's important to include a certain package of service in a good level of quality experience. Otherwise, we can not only increase rents because utilities has grown, they will ask for more, even if they know that the market is growing in terms of cost and in terms of rent. So that's our key message to when we're talking about the rents, which are the services that we're going to include in those rents, in order that the quality expectations of our students will remain the same or better than it was in the past with lower rents. So this is more or less our main goal for the next academic year.
Yeah. Spot on. This is going to be key. And there is obviously cost increases on utilities and on our side, because we operate also the hotel function and the co-working function in our facilities. We have also hotel staff costs that need to be reflected. So there's a bit of upward pressure on that as well. To compensate that, rents need to increase, but at the same time, expectation of students, and especially, I think we're a bit in the higher segment with international students coming for relatively shorter periods. They're not staying for the full stay for the full education period with us. And normally it's 6 or 12 months. Yeah, the expectation then, if you go abroad, you want this to be the time of your life, and you also choose for a location such as the social hub because of the community and the community vibe. So that also needs to be supported, and the facilities to drive that community vibe also need to be there. That means large common areas, quality areas, and facilities, from bikes to Wi-Fi to gyms, pools, everything. I think this is determining how the experience is. So rates increase, yes, but value for money is key.
Before we probably let Josh and Rob comment, can we get the results of the polls? Okay, so the majority of the audience believes that the rents will increase more than 4% next year, 53%. 36% of the audience thinks that they will increase up to 4%, and 9% of the audience believes that it will stay the same, and only 3% believes it will decrease either up to 3% or slightly more. Rob, Josh, I think this is not outside of the expectation that the majority believes in the greater, even speed up increase in rents next year than last year, which was 3.3 in average. So more than 4% next year. It's basically the same feeling that we are sharing here, right?
Yeah, I think that's right. And we touched on, there are two key line items within the operational costs where we're seeing higher inflation than perhaps other items, which are the utilities and the staffing costs. But we have to put that into perspective that while they are the two largest items, we still have strong gross to net margins, and therefore, by increasing rents north of 4 or 5% should still result in sort of covering off all of those costs. I think it's important to note that customers do appreciate and understand that there are changing dynamics. I think the Globe knows very much about the increased utility costs and the effects that's having. But certainly in the UK, you see labour costs are constantly discussed, and throughout the UK, we're seeing strike after strike. And I'm sure that's being replicated in other countries across the globe. So that's definitely a challenge. It's absolutely important that we always have the customer first and thinking about how that increased rent is affecting them. And Mark's absolutely right that you have to be clear with your customers what that service entails. But it's the benefits certainly what GSA and Yugo do and what majority of PBSA operators do is provide that all-inclusive pricing. So it gives the customer certainty on what they're paying. They're not then exposed to the volatility of utility rates and going up and down. They know at the beginning of the year they can budget accordingly, and that is then a fixed price. And how we try and help those that feel that is a struggle. It's important across our buildings that we provide a product which has multiple layers of differentiation. So anything from a twin room all the way through to a studio, giving that diversification of choice and giving the customer an affordable option through to their own private space.
Josh, do you want to comment?
Sure. I think most of the other panelists have covered this topic pretty well, so I won't belabor it too much. But the one thing I will add to, I think a lot of times when the discussion comes to rent increases, and particularly in the context of affordability, one thing that is important to remember, and a lot of times is missed, is again when you look at maybe the rent increases for this year as being slightly outsized relative to a more normalized year. That is a point in time, and remember that we're coming out of a couple of years of a COVID period where rent increases were actually, in many cases flat or relatively small growth. So if you actually take a longer view and look back over the last 3 to 4 years and look at the compounded growth over that period, you actually see a very normal trend and not anything that's really outside of the ordinary. So in some ways, the last year and maybe moving into next academic year is kind of playing a little bit of catch up.
Thank you. We have one interesting question from the audience here that maybe if somebody wants to comment. So I'm pulling out the question, and I'm also encouraging the audience to post questions in a chat if they wish. That how the sort of rapid increase in rent and lagging supply are going to impact demographic composition of student demand for PBSA in terms of local to international students in the UK and Europe. With more increasing rents, will we see more international students in-house, or we believe that this will be the same?
I can take that if you want. So I think it will be a huge impact. At the end, study abroad programs are paying more than national students. So I think we will be represented in a high level of occupancy with the students than before. It's true that before COVID, we were sometimes really exposed to the student segment, and what COVID do is that all the international students left completely the properties because of COVID. No, so it was a quite risk to come back again with a huge percentage of international students after COVID. But at the end, the reality is that they have much more budget than maybe local students. So I see a percentage increasing in the number of students due to the fact of higher rents for sure.
Mm-hmm.
I think it's probably exaggerated in the less mature markets. So if you take UK being the most mature market in Europe, and it has a significantly higher provision rate, it also means that it has a much larger stock of student accommodation and a high percentage of that at a different age. If you take there's been student accommodation in the UK since the early 90s, and you're going to see that older stock being more attractive to the domestic student because it will have a better affordability. Whereas the new stock, it's very much at that higher end, and you've got international students who are paying a lot of money to study in country, and therefore the incremental cost of that accommodation probably isn't as material as it would be for the domestic. And what you're then going to therefore see is in mainland Europe, you're potentially going to see a much higher proportion of internationals because the domestic student will be familiar with renting a house or a flat in whether it's Madrid, Barcelona, Paris, or wherever. Whereas the international, I can only imagine how difficult it is for someone to try and rent a flat in a country where you don't necessarily speak the language or understand the processes. So they are very much going to be targeted towards the PBSA because it is a one-stop shop where they have everything done for them. And if price is a sensitive item, the domestic student is going to go through the additional pain in order to save cost.
Thank you. If we can move to another very sensitive topic and transaction and yields. Over here, basically, we are receiving a lot of challenges and questions from our clients and partners and banks, and where the yields are, where they should be. We see some adjustments. So temporarily, we see that the yields slightly expanded. Exit yields, but there are mixed views on where the yields will be in the future at the time of exit. Let's say in 24 onwards, where will they come back to the same level as in 2022 or pre-2022, or they will even more compressed under the pressure of lack of supply and abundance of capital. So with this, I would probably ask my colleagues to put a question to the audience on this topic, and we start a conversation on transactions and yields. So the question is, where do you expect exit yields to be in 24? So not next year, but the overcoming year, and 24 onwards compared to 22 levels. So the exit yields will expand more than 50 bips, up to 50 bips, same as now, or will compress to pre-Q4 22 levels, or will compress even more. So the benchmark is current situation, and you believe that in 2 years onwards from now, it will be up to 50 bips expanded or more, or the other way around, it will compress to pre-22 levels or even more. We understand this is a little bit difficult question, but probably as good as it gets upon the circumstances. And here I would start with the transactions and yields. So we have seen record numbers of transactions in 22. However, in the UK, 92% of transaction volume happened in Q1 to Q3, and only 8% of transactions volume happened in Q4, so it slowed down. While in the continent, it was pretty well distributed, about 25% each quarter. Even in Q4, we noticed and recorded 22% of the overall transaction volume happened in Q4. So Q2 and Q3 were stronger, but not that much. So we see much more balanced development over there. Now we see that the situation is not like in after GFC, and the capital is there and ready, but waiting for the market to meet their increased criteria on either IRR or yields expectations. So maybe my question to the audience is that transactionally, where do you expect 23 to be? We will see more or less. We will see more portfolios than single assets being a target. Do we see that the DD time will be 2 times longer than previously, because it needs to be studied much more and more intelligence need to be there? How do you see transactional world of student housing in 23? And maybe we can start with Jochem, as you might be quite close to the topic.
Yeah, thanks, Samuel. This is indeed, well, not so much a difficult question, but more a difficult answer to provide. I think the right thing for me to say would be to indicate that the yields will expand more than 50%, since we're on a buying spree here. We would like to expand the portfolio. So with all the attendance in this pool, that would be maybe setting the appropriate stage. In all honesty, I do think yields will expand a bit, and for the simple reason of the connection between interest rates and yield. Obviously, yields need to be a bit, or need to be sufficient margin between yields and interest rates. And with interest rates having gone up the way they have, it would make sense for yields also to increase despite the steadiness of the business and the steadiness of demand and the lack of supply. So I would think there would be a small uptick. So anywhere between 0 and 50 pips would be my estimate if I would have to give an indication. But then again, it is difficult to see, especially if your question is to pinpoint it in 2 years from now. With the uncertainty in the coming period we discussed before, uncertainty in terms of also financial markets, liquidity being available, not so easy to obtain financing at this moment, which is also not helping transactions realize or materialize. So combining those things together, I would say somewhere between 0 and 50, but I'm very curious to see the outcome of the poll and also very curious to hear the comments from my fellow panel members.
Yeah, Josh, your view on a transactional perspective of next year or coming year?
Sure. I'm gonna hide under my desk and punt on trying to prognosticate where things are going in 2024. But I will say, you know, I think in terms of where things have moved already, I think it is important to at least be clear on, you know, what the original comparison point is, right? Because if you look back to early 2022, there actually was some yield compression in the first part of the year before the slowdown hit. But if we're looking at where things were kind of just prior to the summer, when, you know, kind of when the slowdown effectively started, you know, we've obviously seen some expansion then. I think it's interesting to you know, separate maybe some of the flagship cities as opposed to secondary and tertiary markets. And I think in some of the flagship cities, we've actually seen obviously less expansion. I think it's probably more in the neighborhood of, you know, 25 bips or less even in some cases. I think some of the secondary and tertiary markets, you know, you're probably getting closer to that 50 basis point number that, you know, that we've seen in other places. And I think it's also interesting to compare PBSA to other commercial sectors too, right? Where, you know, office yields have moved much more, actually, industrial has moved more. And I think that, you know, that's a further kind of feather in the cap for the PBSA sector in terms of, you know, being less volatile, being defensive in nature, and having some of those really attractive attributes where it's somewhat de-risked or delinked from some of those macroeconomic trends that we're seeing. The other point I'd make is that from a capital value perspective, it's also important to look there, because while yields have moved a bit, you know, there's been strong rental growth and NOI growth. And where yields have moved, we've actually seen capital values hold up because it's been somewhat offset by, you know, some of the growth in NOI. So I think that's a part of the story that needs to be incorporated as well when you're looking at, you know, capital values on a per bed basis.
Mm-hmm. That's a very good point. Yeah. Rob, Mark, do you want to comment?
I think it's very similar to what Josh just said. It is very much going to be location specific. You know, we're seeing it, you know, in, you know, particularly in the UK, where you've got tertiary, secondary markets. You're going to see a wider expansion. You know, while student numbers are increasing, there is that flight to quality of university, and so that's definitely going to sort of play a key part in the answer to what is that spread. You can come up with arguments anywhere between 0 and 50, and, you know, in sort of the main markets, and then, you know, Josh is absolutely right that, you know, in the stronger locations we have seen, you know, and particularly where the supply is short, you are going to see sort of capital values certainly holding up because of the rental growth opportunity to offset.
Great. Mark, you want to comment or?
No, nothing to add. I think my colleagues are much more experienced than me on transactions. I am more on operations, so but I can feel that it's more or less the same message. So growing in the future should be key, and let's expect that is like that. So nothing to add.
Great. So Gorazd, can we have results of the polls to see how does it compare to what we were discussing? Okay. So here we can see that this is pretty much in line what the panelists mentioned. So about 21%, go bottom up, about 21% of the audience thinks that the yields will compress from 24 onwards. 23% believes they will stay the same. And about 42%, majority of the audience believes that yields will expand up to 50 bips, some mild adjustment correction. and only 13% of the audience believes that they will expand more than 50 bips. So this is pretty much in line with what we experience in the field. With this, I would probably move to geographies. Where do you see next year to be sort of playing out better globally? You know, is it States? Is it Canada? Is it LATAM? Is it UK, Europe, or Australia, Asia? Where do you see your investment being placed the best for the next year for the market? We see different strategies from investors, if I may say that those who are looking for higher IRRs, they usually go to new markets where they can earn on development, while the core capital is rather looking for the more mature markets and existing stock. We see more demand for portfolios, sizable. So we expect some of the portfolios coming to the market out of the 280 plus portfolios. So where do you see the investment going on geographically?
From our side, from Aparto side, we're quite focused on Europe. Pipeline is coming much more related to the south of Europe, if I told you the truth. So Italy is one of our key markets right now. We have a pipeline of around 5 student housing in Milan and 1 in Florence at the moment, and another 1 in Barcelona. So at the end, it will come in the next 2 years, around 3,000 more beds in Southern Europe. Even of that, we are also interested in main cities in Europe. We continue to grow in some offers with UK and Ireland market, and also trying to go and for the first time with Aparto in other cities in Europe. But mainly, the pipeline will be focused on the south of Europe at the moment.
Yes, well, on our side, we're also very much focused on Europe. We have no hotels as of yet beyond this. So this is going to be the focus for us, present in 8 countries, and it is only logical to first expand where we already are, because it's, well, you'll learn from your previous experiences. So it comes from a development angle, but also from an operational angle. It's just more easy to expand the platform on locations where you already are. Having said that, we already have 8 countries. I don't think there is a preference for one market over the other. Although, of course, with the Netherlands, where we already have 8 locations operational, the room for growth, although we still think it's there, it's going to be more pinpointed on certain cities. Whereas in other markets, for example, for Germany, where we only have 1 hotel operational now, we intend to grow in that market, obviously, as well as France and Spain. UK is an important market as well. So yeah, from a return perspective, I think for us, countries are not so much leading. It's just the micro location, which is driving whether we do the investment or not. And another angle compared to pure PBSA is that for us, it's also important that there's a strong hotel market present. Our model works best where there is a bit of both. So when the students go home in summer, there's a good hotel market to capture the empty hotel rooms or student rooms that we're having. We can put them on the market there. So that's a bit the route that we're following on that.
Before we go to Rob and Josh, if I can ask my colleagues to put the last poll questions to the audience, which is about the overall investment mood and trends. I think it's question number 1. Yes. So that so as we have investors, bankers, operators here, we made this question a bit more general. So in 23, I want to be exposed to the student housing asset class. More than 10% and so far, slightly more, up to 10%, same, or slightly less, or much more, less, significantly less than 10%, which should give us a indication of the investment mood or expansion mood, or the overall sort of appetite for the asset class. So we keep this question open, and apologies, Rob and Josh, that I interrupted. I just wanted to give the audience time to answer before we conclude then. Thank you. So if I can ask you comment on the topic of the investment, that would be nice.
Sure. From a GSA perspective, we had a very busy 24 months in the US, having sort of gone from zero to over $1.6 billion of assets under management and sort of transactions largely acquired during the COVID period, which was certainly interesting, trying to buy portfolios over Zoom. But the team done a fantastic job in getting that across the line. So the US strategy is very much incremental to the markets that we're in. That's going to be a key focus from that perspective. The portfolio that we bought was very much a value add play, where it's brought in opportunity to roll out a significant CapEx program across that platform, and very much looking to enhance that portfolio as the business grows on that front. From a European perspective, I'd love to turn around and say, we're out to buy lots of portfolios in mainland Europe. There are very few. Yeah, we've talked about a relatively low provision rate. So it would be interesting to see what actually is brought to market. We touched on the fact that the difficulty of actually obtaining debt finance is certainly going to be limited. We talked about the core banks only lending to people with strong track records. So in light of what we've talked about in terms of where is the appropriate pricing, are people going to bring portfolios to the market in the next 3 months, or is it going to take a bit longer and wait for some evidence of single assets? But I don't think we can rely on single assets to be the factor and sort of determine the pricing. So from a European perspective, we look at a wide range of transactions. We've got a significant experience in the development space, that's more likely to be sort of UK focused, but from anything from forward funds, single asset to portfolios, but that's going to largely be across the 5 core strong markets in Europe, where you've got your Spain, France, Germany, Italy, and obviously UK was the 5th in that one.
Josh, if I can ask you for closing remarks.
Sure. I'd say just if we're kind of keeping it within the European and UK geographies, I'd say for us, I think Southern Europe is very attractive at the moment. I think, from a supply demand perspective, it has the greatest imbalance. I think we've touched on provision rates are lower there, frankly, than some of the other geographies in Europe, and that you're seeing, south of 10%, frankly, in terms of provision rates in most of the, the Southern European markets, which is very attractive. There's also high barriers to entry there in terms of developing new assets. And it really is a challenge if you're not on the ground local and really know what you're doing and can navigate the process. So we see that as, as something that's a huge advantage for investors that are able to execute in those markets. I'd say the last piece I'll mention too is just from an affordability perspective. I think in a lot of those markets, we're targeting a very affordable product there. We're being very cautious in terms of investing in assets that are really only ultra high end and geared mostly towards international students. That's a big piece of our strategy, and that we're trying to focus on affordable product that appeals to domestic students as well as internationals.
Great. Well, thank you all for your precious time, your sharing experience and views and opinions. I believe that in these uncertain times, this more intelligence, either from us or from you, was useful. It seems like the research is critical for these challenging times. I saw many of the questions in the chat that were not answered, but they will be, so you can expect our team to get back to you. And if anybody has more questions or need in terms of data research or intelligence or insights, our team is available during the year. Thank you very much also for all the participants and delegates that came. The report, as mentioned, will be delivered to you by email in the course of this week. And if you are not one of the delegates, but you want others to download it, please go to bonar.com section Insight. Thank you very much, and wish you all the best for today and all year.